The American banking sector could be facing a depression amidst a crisis, and this time it's Silicon Valley Bank, the 16th largest bank in America, that has failed. As a result, depositors are in a state of panic, withdrawing their money from the bank, leading to a bank run. The cause of this issue is the Federal Reserve, as they are currently removing money from the system, resulting in a contraction of the money supply by 2% year over year. This is the first time in nearly 100 years that we've seen such a contraction in the money supply. This alarming development has occurred only 4 other times in U.S. history, all of which led to a depression. Before we delve deeper into how to prepare for a deflationary depression, I want to acknowledge that words like depression and banking crisis can be alarming. However, I'm not trying to create fear. I'm simply connecting the data available in the economy right now. What is concerning is that until yesterday, no one was talking about the possibility of a banking crisis. The recent events have made it clear that a banking run is a real possibility. The Federal Reserve suspended reserve requirements when the pandemic started, which means that banks were not required to hold 10% of all their deposits on hand at the bank or in a vault at the Fed. As the pandemic swept the globe, the Federal Reserve made a bold move. They suspended the reserve requirement for banks. This means that banks are no longer required to hold cash on hand. It's a risky move because it could lead to bank runs and banking crises. The impact on the economy could be severe, and it's likely that we'll see deflation instead of the rampant inflation we're seeing now. What's happening in Silicon Valley could happen to other banks across America. Stocks like First Republic Bank are down 37% in just 5 days. Investors are worried that bank runs will spread to other banks, especially those exposed to tech. With the tech industry struggling, startups and companies are desperately trying to withdraw cash from their accounts. But with no reserve requirements, and banks typically only holding about 10% of their deposits in cash, there simply isn't enough cash to go around. This shortage of cash could ultimately lead to a banking crisis and a depression. If we look at the graph showing the change in money supply, we can see that it's already contracting. This is a worrying sign, and we need to take action to prevent a full-blown crisis. Let me tell you a story about a few times in history when the money supply contracted and how it affected the economy. Back in the 1870s, the money supply contracted by 2%, which led to a period known as the Long Depression. The unemployment rate skyrocketed, reaching double digits, and deflation was rampant. The same thing happened again in the 1890s during the panic of that time, which caused another depression with unemployment potentially going as high as 18%. Fast forward to the Depression of 1921, where the money supply contracted again by 2%, leading to another period of high unemployment rates. Finally, the most infamous contraction of the money supply occurred during the Great Depression, where we saw bank runs, banking crises, and severe deflation. All of these events had one thing in common: they caused immense hardship and suffering for the people who lived through them. Now, as we approach the year 2023, it seems like we may be headed for another such contraction. There are signs all around us that point to the possibility of a deflationary depression, including the banking crisis in Silicon Valley, the Fed's aggressive interest rate hikes, and the initial signs of a recession in sectors like real estate. If history is any guide, we could be in for a rough ride. So what can we do to prepare for this possibility? The answer is simple: hold on to some cash. Not in a bank account, mind you, as recent events have shown us that banks can fail and leave their customers high and dry. No, it's important to have some physical cash on hand, in a safe place in your home. Maybe it's just $1,000 or $2,000, But having that buffer could mean the difference between surviving for a few weeks or a month until the government and the Federal Reserve step in to rescue the economy. Are you ready for a story? Let me tell you about something that happened to me a few months ago. I was trying to transfer a decent sum of money from my business account to my personal bank account. It should have been a straightforward process, but my bank blocked the transfer. I thought it was strange and decided to call them up to find out what was going on. Over the course of several days, I ran into a series of security identification issues that prevented me from transferring the money. Even when I spoke to a real person at the bank, they couldn't help me because the security identification wasn't working. It became clear to me that my bank didn't want me to take the money out and transfer it to another bank. This experience was a wake-up call for me. It made me realize that, technically, the money in my account isn't really mine until it's in my hands or in an asset that I control. I don't have access to it, and I can't use it the way I want to. It was a scary feeling, and it got me thinking about the larger economic picture. With everything that's been going on lately, there's a good chance that we could see another bailout and more money printing. It might get messy, and there could be consequences that affect our ability to access our own money. It's a scary thought, but it's important to be aware of what's going on and to be prepared for any potential disruptions. So, let's stay informed and stay vigilant. Let's make sure that we're doing everything we can to protect our assets and our financial well-being. As I sit here contemplating the latest news on the tech bank in California, I can't help but feel a sense of unease. Some people are quick to write it off as a minor blip on the radar, just a small bank with exposure to crypto and tech startups. But is that really the case? Are we sure that this won't happen elsewhere to bigger and more established banks? Yahoo Finance makes a valid point, stating that the U.S. banking system is much stronger than it was before the 2008 crisis, thanks in part to regulators forcing banks to hold more capital and undergo stress tests. But can we really be sure that this will protect us from another crisis? There's something else to consider here, something that could exacerbate the situation even further. The Federal Reserve is currently contracting the money supply through quantitative tightening and increasing interest rates. This means that people who are saving money are being incentivized to pull their money from banks and invest in U.S. Treasuries instead. With a 4.74.8% return on a one-year U.S. Treasury, this is a much better option than a savings account at a bank. But what does this mean for the stability of the banking system? We are living in unprecedented times, with the pandemic causing massive amounts of stimulus and money printing, followed by a complete reversal of these policies. It's a delicate balancing act, and it's unclear how it will all play out. Will we see more banks falter under the weight of exposure to risky assets, or will the increased diversity of funding and stronger regulations prevent another crisis? Only time will tell, but one thing is for sure, we need to pay attention to what's happening in the world of finance and be prepared for any eventuality. Have you ever wondered what happens when a country has too much debt? Well, historically speaking, it's not an uncommon occurrence during times of war. However,
the government has been borrowing money left and right, and the infusion of that money into the economy through stimulus checks and assistance has kept the economy afloat. However, with rising interest rates, this debt burden is becoming increasingly unsustainable. When short-term interest rates were at 0 2 years ago, the government could borrow as much money as it pleased, without having to worry about paying a substantial amount in interest. Fast forward to now, with short-term interest rates at 4 or 5%, the government's burden of paying interest is going to rise significantly. As a result, its ability to take out more debt will be constrained, which could cause the economy to collapse. The continued infusion of debt into the U.S. economy has helped keep consumers afloat. However, with their personal savings rates at a record low and many having to resort to credit cards to make ends meet, the situation is concerning. As an economic analyst, I believe that the Federal Reserve will continue to raise interest rates and implement quantitative tightening, effectively removing money from the system. Additionally, with Republicans controlling Congress during Biden's presidency, it's unlikely that we'll see a fiscal bailout anytime soon, unless the situation worsens. Only if the unemployment rate rises from 3.6 to 10 will there be widespread support for such a measure. Unfortunately, there will likely be a period of uncertainty in between, which could prove problematic for those who are heavily in debt and struggling to make ends meet. I didn't plan on making this video, and it's different from my usual content, but I felt it was important to share this warning. Some may think that I'm being alarmist, but there are several warning signs of a looming recession that cannot be ignored. For instance, there's the banking crisis in Silicon Valley, the contraction of the money supply, the Fed's aggressive interest rate hikes, and the collapse of the housing market. While a recession may not be the most probable outcome, it's still something we should prepare for. Practicing caution and keeping some cash on hand, as well as investing in gold, may be wise in these uncertain times. I hope you found this video informative and helpful. Let's be proactive in safeguarding our finances and preparing for whatever the future holds.